How you doing? I'm Big D. Welcome to the show. I do appreciate each and every one of you spending a few minutes of your day with me to learn exactly what's going on with silver, gold, commodities. This is a this show is going to be about what happened with the crash of silver, gold, commodities, stocks, crypto, anything you can actually think of that could bring down the dollar. Let me know what you think in the comments as well. Now, if you do leave a comment, I'll leave a comment for you. Let's start with uh let's start with yesterday. Now, it was Friday, January 30th, 2026. I believe it will go down in history. It will be studied in economic books. It will be analyzed in market forensic courses. It will be remembered for one of the most catastrophic single day collapses in precious metals since 1980. Gold plunged 12% from its Thursday record high of 55, almost $5,600. Now it was below $4,900. Silver suffered a historical 25 to 35% intraday crash, dropping from nearly $120 in the high of that morning. Approximately $35 gone in hours. If you're hurting right now, if you're looking at your portfolio Friday night, or even this morning, and you didn't even hear about what's going on, you might feel a little nauseous. If you're wondering whether the bull market is dead, whether you should have sold at the highs, whether everything you've been tracking for months just evaporated, you're not alone. But this was not a normal correction. This was not healthy pullback. This was not a something that was normal. This was a political earthquake disguised as a market event. This was a rug pull orchestrated at the highest level of the power that caught everything, even the smartest institutional traders, off guard. And might I say, completely off guard. Did President Trump just switch sides? I don't think so. Did he betray the weak dollar policy he championed 72 hours earlier? Did he deliberately crash the precious metals market to teach someone a lesson? Please, again, if this is something that's interesting to you and you like to see these on a regular basis, the updates, especially of silver, gold, crypto, I usually have something going on almost daily. Please hit that subscribe button. But if you want the truth about the Kevin Warsh nomination, now that's what happened, and I believe that's what triggered this. Definitely turn on the notifications so you get all my updates. Sorry, I'm trying to go through my notes as I'm giving you the details. The connection between Trump's Tuesday statement in Iowa, the Friday morning announcement, the dollar spike, the metals massacre is not a coincidence. It might be my opinion at this point, but I think it's going to be proven. It's a coordinated policy shift that Wall Street is calling either the greatest political betrayal in modern financial history or the most brilliant strategic repositioning of American monetary policy since Paul Volcker. Let me start with a timeline because the consequences of events matter. The word matters. Timing matters. And when you put it all together, you realize that Friday's crash was not about fundamentals. It was about politics. Tuesday, January 27th at 12:45 p.m. Eastern Time. Urbandale, Iowa. President Trump is standing in front of local business owners doing a press gaggle. The reporter asked him directly about the dollar's decline to a 4-year low. The dollar index, the DXY, and it had fallen to 95.566, its weakest level since February 2022. Now, if you also look at the purchasing power of the US dollar, that is a different graph that you might want to look into as well. Now, Trump's response, well, let me read it to you. I think it's great. I think the value of the dollar is it's doing great. He didn't stop there. He explained the logic. He said, I quote, if you look at China, Japan used to fight like hell. We used to fight like hell with them because they always wanted to devalue. A weak dollar means you can sell tractors, you can sell trucks, you can sell anything. Now, that wasn't an off the cuff remark. Trump had been saying this for months. I don't know if you remember back in July of 2025. He was even more explicit. He said, when we have a dollar, a strong dollar, one thing happens. It sounds good, but tourism is bad. You can't sell tractors. You can't sell trucks. You can't sell anything. It's very difficult. But you make a hell of a lot more money with a weaker dollar. I don't know if you remember that, but that was something that you need to take to heart and understand that he was doing that as this is what's going to happen. This is what I'm going to do, I believe. So not a weak dollar, but a weaker dollar than you do with a strong dollar. The market heard this loud and clear. They didn't hear it last year, but they heard it this week. They understood it this week. The dollar continued falling. Gold continued rising. Silver exploded higher. Everyone interpreted Trump's comments as an explicit green light for dollar debasement. The President of the United States was openly endorsing current weakness. The implementation, my apologies, implications were massive. If Trump administration wanted a weaker dollar, the Fed would have to accommodate. That meant more rate cuts. That meant quantitative easing. That meant the easy money regime that fueled the 2020 to 2025 asset boom would continue. Gold to $6,000, silver possibly $150. That was the trade. And then Friday happened, 4 a.m. to 4:23 a.m. Eastern Time. July 30th, President Trump announced via Truth Social that he is nominating Kevin Warsh to succeed Jerome Powell as Fed chair. Trump stated, and he quoted, I'm quoting, I have known Kevin for a long period of time and have no doubt that he will go down as one of the greatest Fed chairs in modern day history, maybe the best. And the market said, wait, what? Kevin Warsh, 55-year-old, former federal governor, reserve governor from 2006 to 2011, that guy? Yep, that's the guy. Served as Ben Bernanke's primary liaison to Wall Street during the 2008 financial crisis, and universally recognized as an inflation hawk and balance sheet reduction advocate. This is not a weak dollar guy. This is not a print money and cut rates guy. This is a sound money advocate who has spent the last decade criticizing the Fed's easy money regime. Now let me read you Kevin Warsh's core philosophies in his own words. Inflation is caused when government spends too much and prints too much. You know, there's way too much money, much U.S. dollars out there, and it's bringing America down. Money on Wall Street is too easy, and credit on Main Street is too tight. His policy prescription includes, number one, shrinking the Fed bloated $6.8 trillion balance sheet through aggressive quantitative tightening. Number two, rejects the dogma that economic growth and rising wages cause inflation. Number three, lower short-term rates only after draining liquidity via balance sheet reduction. Number four, restore regime change at the Fed to rebuild institutional credibility. Do you see the contradiction? Now, on Tuesday, Trump says weaker dollar is great. On Friday, he picks a strong dollar hawk. One of these statements has to be a lie. Either Trump was lying on Tuesday to manipulate the market, or he's lying back by picking worse, or this is the scariest option. Donald Trump doesn't understand the contradiction and is making monetary policy decisions based on vibes and personal relationship rather than coherent economic strategy. The market's response was immediate and volatile and very violent. The US dollar index surged from 95.55 to Tuesday's low to 97.15. Now that's a 1.7 gain. That is the largest single day move in the dollar index since July 2025. The euro collapse against the dollar, falling 1% as safe havens flows reversed. The Japanese yen weakened despite earlier intervention speculation as strong dollar overpowered risk-off sentiment in precious metals. They got absolutely annihilated. Gold plunged Thursday from $55.75 record to an intraday low of $4,700. It did bounce back a little bit. That's a 14% decline. It settled around 4,900 and something, 90 maybe, by session close. A 10% loss overall. Suffer from silver is a catastrophic 30 to 35% intraday collapse from a high of, I believe it was really close to $122 the last I saw on the graph, to as low as about $74. Now, when it stabilized and bounced back a little bit, it ended up right around $86 range. Now, that's the worst day percentage drop in 46 years. And that 46 years ago was a manipulation as well of the market. Now, the gold and silver ratio spiked to about 50 to 1 from a 46.3-ish, signaling silver disappropriate weakness, and the mining stocks decimated. Ponant Tinkerum, I believe I'm pronouncing that correctly, plunged 11.5% to $112.30 on an 85% average volume, 19.1 million shares traded. Market cap lost $14 billion. Barrick mining ticker B collapsed 12.1% to 45.74 with 31 million shares traded, a 91% volume surge. Market cap lost $9 billion. Hecka mining down 12%. Freeport McMoran down 7.5%. The Vanek Gold Miners ETF, ticker GDX, down 11.9%. The Vank Junior Miners, Gold Miners ETF, GDXJ, sank 13.77%. Both recorded their worst session on record. The iShares Trust, Silver Trust, the SLV, collapsed 28 to 31% intraday, marking its deepest single day drop in ETF history. The SPDR Gold Shares, GLD, fell 10.5% on track for its worst day on record. ProShares Ultra Silver, AGQ, the largest silver ETF, down 25% in pre-market trading. This was not a correction. This was a liquidation event. This was forced selling on a scale we haven't seen since the Hunt brothers. The collapse, when 1980, silver fell 27%. Silver's Thursday, as a margin rule, changes triggered forced liquidation. Now, here's where this connection to our last video. I don't know if you were able to preview it yet, but if you get a chance, please go back to yesterday's videos I put out too. Now, because you've been following this channel, and hopefully there's some new ones out there going to be new watchers, going to be new subscribers. You know, we cover the Microsoft crash on Thursday. We explained how Microsoft dropped 10%, whipping out $357 billion in market cap. I explained to you how that it triggered margin calls across the hedge fund complex. I showed you how hedge funds were long tech stocks and long precious metals simultaneously got squeezed. They forced margin calls on their Microsoft positions. Their prime broker said, you need to post more collateral right now or we liquidate everything. And what did they do? They sold their most liquid positions. Gold became, quote, the perfect ATM for raising cash. As one analyst noted, in a market with trading volumes at such high levels and with leverage longs so stretched, it doesn't take much to trigger moves like what we seen on Friday. Microsoft crash set the stage. The war's nomination was the trigger, and the combination created a liquidity waterfall that took out 46 years of support levels in a matter of just a few hours. Multiple technical signals had flashed red in days preceding the crash, my apologies. Gold's RSI, the relative strength index, has reached 90, its highest in decades. Levels above 70 indicate overbought conditions. Above 90 suggests extreme vulnerability to pullbacks. Silver's RSI was similarly elevated, with the metal trading more than 100% above its 200-day moving average, historically unsustainable. Now, the distance from moving averages was a stretch that analysts were warning, and the near-term technical backdrop is stretched. So when the worst news hit at 4 a.m., when the algorithm scanned the headlines and saw inflation hawk, balance sheet reduction, sound money, strong dollar, they didn't hesitate. They sold immediately, violently, without mercy, because if Warsh is confirmed, and if he's confirmed, and he will implement his stated agenda, aggressive balance sheet reduction, without offsetting quantitative easing. The liquidity environment that fueled 2020 to 2025 asset price gains disappears. As an analyst warned, the market crash wasn't just about fear, it was about recalibration. For the first time in years, markets are being forced to confront a reality that has been long ignored. Easy money is no longer a certainty. Markets immediately priced it's in a scenario where rate cuts will be accompanied by balance sheet reduction, not the open-end liquidity injections, QE, that fueled the bubble. And if rate cuts no longer guarantee quantitative easing, then risk assets must be repriced under a tighter liquidity regime. Gold at 5,600 was priced for infinite quantitative easing at around $4,900. It's priced for war-style quantitative tightening. Now let's address the political angle, because the media immediately framed this as a flip at a betrayal. Now, the Wall Street Journal ran a headline: "What might Kevin Warsh do as Fed chair? Rapid growth, pay raises aren't the problem. Inflation is caused when government spends too much money and prints too much." Now, Reuters ran with Trump: "Strong dollar sounds good, but you make a hell of a lot more money on a weaker dollar." CNBC analysts described Warsh as a representing, quote, "that end of the easy money narrative." Political economic observers noted that it's incoherence. One wrote that Trump's tariffs have already added roughly half a percentage point to the inflation in 2025. The United States national debt sits at 38 trillion. Entitlement spending is on an autopilot. Um, Trump is trying to curb that. None of this gets solved with sound money. It gets solved with inflation quietly over decades. That's the past, though. Could something be changed? Well, here's the kicker. As of Saturday morning, President Trump has not publicly addressed the contradiction between his weak dollar advocacy and his selection of the strong dollar Fed chair. Treasury Secretary Scott Bessent reaffirmed the strong dollar policy on January 28th, further confusing the market participants. So we have Trump saying the weak dollar is great on Tuesday. We have Trump picking a strong dollar hawk on Friday. We have Bessent reaffirming the strong dollar policy on Wednesday. What is the actual policy? Nobody really knows. Do we ever know what's really going on? I think Trump is the more transparent president that we've ever had, with True Social, because regular media, deep state media, whatever you want to call it, fake media, you're never going to know because they're going to manipulate whatever Trump says. But are we supposed to know that he's got to do something really aggressive to get us back on track? Those are the things that I think are going to have to be seen before we can really believe that he's doing what he has stated he's going to do. But let me show you or give you a little specific carnage across the asset classes. Silver collapse was particularly brutal, especially to a lot of people I know. The metal lost $35 in a single session within hours. Analyst Michael Brown of Pepperstone described it as a, quote, every man and his dog rushing for the exit at the same time. The magnitude exceeded even the 1980s Hunt Brothers collapse. On Thursday, silver on Thursday, March 27th, 1980. Silver fell 27% as margin rule changes triggered forced liquidation. Now Friday, 30% to 35%. Intraday drop was worse. It was the worst day percentage decline in 46 years, while comprehensive outflows data from Friday remains pending. Preliminary reports indicate the iShares Silver Trust, SLV, down 28 to 31% intraday, with forced liquidation dominating a margin call cascaded through the system. The SPD Global Shares, GLD, fell 10.5%, like we talked about earlier, on track for its worst day on record. Now, collapse for anyone using this leverage. And here's the cruel irony. Just earlier, SLV attracted record retail inflows of 171 million. On Monday, January 27th, nearly doubled the previous one-day record during the 2021 Reddit silver squeeze. Those buyers, retail investors who bought at 110, 115, 120, forced catastrophic losses within 72 hours. I don't know, were you one of those? No, they bought the top. They got destroyed. And the institutions who sold them, they're fine. They liquidated the highs and bought back at 85. Well, let's address the question everyone is asking. Is the bull market dead? Is the end of the precious metal rally, is it an end? Should you sell? Or should you hold on to it? Should you buy the dip? I believe you hold on to it and you buy more. But that's my opinion. See my disclaimer in the description below. Let me show you let me talk about what the analysts are saying, because the institutional review has not changed. USB raised the gold price target to $6,300 per ounce for quarter one, through quarter one through quarter three in 2026. That issue They issued this target on January 29th, hours before the Friday crash. Their research, not argued. We anticipate with private sector diversification buyers whose acquisitions hedge against the global policy risk and have contributed to the upward surprise in the price forecast. Now, uh, will not liquidate their holdings in 2026, effectively raising the baseline of our price estimate. The UBS reaffirms their buying rate Friday morning. As of Saturday, they are not revised. Goldman Sachs set their December 2026 target at $5,400 per ounce on January 22nd. No revised issue post cash. Morgan Stanley bull case for H2206 is $5,700. No revision. Deutsche Bank's December target is $6,000. No revision. JP Morgan's Q4 target is $5,000 with an upside scenario that it could go as high as $8,000. No revision issued as of Saturday morning. No major banks have rescinded its bullish call. Why? Why do you think that is? Because the fundamental driver of the 2020 to 2026 precious metals rally operation remained operational. Number one, central bank demand. They have been purchasing a lot of silver. Central banks purchased approximately 863 tons of gold in 2025, slightly below the 2022 to 2024 average, but still at historical elevated levels. Goldman Sachs projects 60 tons per month in 2026, elevated to 26% of the annual mine output. Now, this demand reflects the structural diversification away from the US dollar assets, accelerated by sanctions risk and geopolitical fragmentation. China's central bank alone bought gold for 13 consecutive months through October 2025, adding 53 tons to that month alone. Poland's recent accumulation signals that the trend is spreading beyond traditional emerging market buying. Number two, the $38 trillion debt problem. The U.S. national debt surpasses $38 trillion in October of 2025, approximately 120% of GDP, and continues growing faster than the economy. Now, the committee that responds federal budget warned Thursday that, quote, let me quote this, some form of crisis is almost inevitable without fiscal correction. Identifying 6 potential crisis scenarios: financial crisis, inflation crisis, currency crisis, default crisis, austerity crisis, gradual crisis. Internal costs on the debt reached $1 trillion in 2025, consuming 18% of the federal revenue. That's more than the entire Medicare budget. As one analyst framed it, and I want you to hear this: Warsh can raise rates, but he can't fix the $28 trillion debt. The only way out is inflation quietly over decades, while officials talk about price stability. Kevin Warsh can implement all the balance sheet reduction he wants. He can shrink the Fed's balance sheet from 6.8 trillion to 5 trillion, then maybe down to 4 trillion. He can raise rates. He can talk about sound money, but he can't change the fact that the United States government has $38 trillion in debt that it can't pay back without inflation inflating the currency. Now, the math doesn't work. The only politically feasible solution is controlled inflation. Debasing the currency over decades while officials pledge price stability. Let's go with number 3. Geopolitical risk and policy uncertainty. Trump's January 2026 actions threatens Greenland annexation, initiating criminal probes of the Fed officials. I don't know if you've seen that yet, but that is going on, and it should. There's many reasons for it. Conducting military operations in Venezuela, demanding Iran's negotiation under the threat of retaliation, have elevated geopolitical risk premiums. I don't know if you've seen that. We're moving into that area with ships and other things. We can get into that another time, but probably won't. I'm just trying to stick with silver and mostly the commodities. So if you'd like to come back, please understand that this show is about silver, gold, things like copper, cryptocurrency. But here we go. So the Sell America sentiment that emerged after Trump's April 2025 Liberation Day tariffs have resurfaced. Number 4, industrial demand for silver. Silver is industrial use, particularly in solar, solar panels, providing a structural demand, floor absent in gold. The Silver Institute projects 665 gigawatts of global solar PV capacity in 2026 alone. And this is going to be the biggest use of silver in solar panels in history, let alone the new Samsung battery that is going to overtake battery in EVs. Going to require a lot more silver, but it charges faster. The battery power lasts longer. It's a game changer. Now, consuming 120 to 125 million ounces, 14 to 15 million electric vehicles adding 70 to 75 million ounces, grid upgrades and data center contributing to 15 to 20 million ounces. Industrial demand now accounts for over 50% of the silver consumption, now up from 40% a decade ago. I think some of these details are incorrect because our deficit of silver every year is going up, and they keep it at only 500 million ounces in the deficit. There's got to be, you can see the industry using more for this, more for that, and it does not show the deficit, even though we only produce in the world 800 million ounces. They say it's only a 500 million ounce deficit for the last several years. So something's not right. You see the industry, what its demand is, and they don't change. Those numbers don't change. So I think we're being lied to. Now, this creates a supply deficit dynamic that gold dominates by investment in jewelry demand does not face. So despite Friday's crash, despite the worst nomination for maybe Trump's plan, what he's told us is the plan, despite the dollar spike, the fundamentals have not changed. Gold and silver, RSI indicators, which hit 90% or 90 plus extreme overbought on Thursday, likely plunged into oversold territory below 30 by Friday close. Historically, such violent reversals create buying opportunities as momentum traders are flushed out of the fundamental buyers accumulative as low prices or at low prices. Even on Friday's carnage, gold is still up 18% from January, plus 700 from $4,300 on January 1st. That's still huge, guys. Silver is still up 11 to 19% for January, despite losing $35 per ounce. So it's still a positive. And what's going to happen Monday? I believe it's going to open at a much higher level. But I'm going to say like 2 to 3, not 2 to 3%, maybe $5 to $10 higher in silver and maybe $100, $200 higher in gold. This is my what I'm saying I believe is going to happen. And if you want to watch when Shanghai opens Sunday late, I think that's going to give you an indicator. So leave it in the comment section. What's your goal to see on Monday morning at the open of the markets? Manav Madi of Model Oswald notes, they noted, gold prices dropped by more than 5%, making the steepest intraday decline since October 2025. Despite the pullback, gold remains on track for its strongest monthly performance since 1980. Friday's collapse was not driven by fundamental deterioration, but by forced liquidation among overleveraged speculators. Margin calls from the equity market weakness. Microsoft's $357 billion wipeout forced traders to liquidate profitable positions. And we talked about that earlier. Now, if you didn't get that, please go back and watch it again. Gold became the perfect ATM for raising cash. Crowded positions or positioning. Gold and silver long positions were incredibly crowded with leverage longs stretched to historical extremes. Now, exhausted gaps. SLV flashed 4 classic exhaustion gaps in the week preceding the crash. Technical signals that a blow-off top was forming. Michael Brown of Pepperstone said, in a market with trading volumes at such high levels and with leverage longs so stretched, it doesn't take much to trigger moves like what we've seen on Friday. So here's my assessment. If Warsh is confirmed and implements his stated agenda, aggressive balance sheet reduction without offsetting quantitative easing, the liquidity environment that fueled 2020 and through 2025 asset price gains disappears. Markets are being forced to confront a reality they've long ignored. Easy money is no longer a certainty. The Trump endorsement of the weak dollar on January 27th and his nomination of a strong dollar hawk on January 30th cannot coexist unless there's a plan. And I don't think we're going to know about the plan, but we are going to see what happens. Now, one of the 3 outcomes must occur. Number 1, Trump pressures Warsh to capitulate. Warsh improvement, dovish policies, despite his rhetoric. The dollar resumes its decline because we are in a different position than we were, say, back when he was the governor, the Fed governor. And he could change his position just because of that to try to get us out of the hole. But when you look at history and how it works, it just doesn't seem right. But I think it's just like Trump's tariff policy. We didn't know how it was going to work out, but we knew that this country was built on tariffs, and we were probably the richest country in the world because of it back then. Before the Federal Reserve and the IRS, all of the things that brought America down, I believe. And that's why I believe Trump has something in plan that we just don't understand yet, because it hasn't happened in history. Now, if Warsh maintains independence, he implements hawkish quantitative tightening, plus slows rate cuts. The dollar rallies, gold and silver consolidates at a lower level for 6 to 12 months. Number 3, Walsh confirmation fails. Trump's pick is a compliant dove, so to speak. Now, think about this. Maybe Trump is putting him out there, and he's getting the media going crazy, right? And thinking the same thing as what we're talking about today. But Trump put him out there because he really doesn't want this guy. What do you think? Could that be a possibility? And then he's got someone in the back wings going to step right in and do exactly what Trump wants to do, and what he stated in the past about reducing interest rates because it's great for the homes. Housing market might bounce back. We're going to have to see. I think it's going to be a great ride. I do really believe that. Now, maybe Rick Rear from BlackRock, easy money returns, gold and silver explode higher. The market priced Friday as a betrayal. Trump's base expected a dovish Fed chair aligned with a weak dollar policy. Instead, they got a sound money advocate who explicitly rejects the quantitative easing regime that fueled asset bubbles. But the fundamental reality is the United States cannot afford sound money. With 38 trillion in debt, 1 trillion in annual interest costs, the entitlement spending on autopilot, the only politically feasible solution is controlled inflation, quietly debasing the currency over decades. Yeah, that doesn't sound good to me. But while officials pledge price stability, wars nominated may prove technically negative, a 6 to 12 month consolidation, but strategically irrelevant. The debt crisis forces eventually currency database, regardless of Fed leadership. So, what should you do? For technical traders, wait for confirmation of support at, well, wherever you want to go with it, $5,000 for gold, say 95 to $100 silver before adding exposure. Avoid leveraging ETFs like AGQ and UGT until volatility subsides. But has anybody made money by waiting? Maybe there's people out there making money by waiting, but now VIX is below 20. Watch the DXY. If the dollar breaks above 98, metals face further downside. Below 95, bullish resumes. The strategic investors, Friday's crash was a gift for long-term accumulation at 10 to 15% discount to all-time highs. The structural fundamentals, central bank buying, debt crisis, geopolitical risk remains intact. Dollar cost average into pricing physical gold and silver over 3 to 6 months. Ignore intraday volatility. Friday's great meltdown of the metals market was a violent reminder that parabolic rallies end in tears. Leverage speculators, retail FOMO buyers, and monumental chasers were annihilated exactly as they were in 1980 and also 2011 in every prior blow-off. But the structural bull case for the precious metals in 2026 is stronger than it has been in 2025. Central bank continues diversifying away from the dollar at 800 plus tons per year. U.S. debt trajectory is unsustainable. For some forms of crisis is almost inevitable. Geopolitical fragmentation, Iran, China, Ukraine, elevates safe haven demand. Silver's industrial demand for solar, EVs, data centers provide supply deficit dynamics. And don't forget what the military consumes that we will never know in the amount of silver that is needed, let alone gold. I don't think there's ever been a straightforward, 100% honest data that's been released by the military than of how much silver and gold that they use in missiles, even, let alone airplanes and tanks, and the electronics that are in those is mind blowing. And look of how much every time that Trump has been in office, how much he spent on military, and that's a lot of silver going into all of the equipment that is needed for the military to keep us number one. In January, gains plus 18% gold, plus 11% silver survived despite Friday's crash. Kevin Warsh's nomination introduces tactical volatility, but cannot alter the strategic inevitability. The U.S. government will inflate away its debt because it has no other choice. The tourists are gone. The margin calls have been issued. What remains is the volatile two-way market that precious metals bulls forget exist. For those with conviction and capital, Friday was the opportunity of a decade. The weak hands are washed out. $85 silver is a gift. If you were around out buying when it dipped into the $74 range, even before it bounced back, you're seeing that as a gift as of Saturday morning. Now, if it's a gift and you believe in the debt crisis, Monday is a test. Monday decides if we bounce or break. Do you trust Trump's play? Was this a brilliant strategy, repositioning of American monetary policy? Or was this a massive policy error or a political betrayal that will haunt markets for months, maybe years? Tell me in the comments. I would love to know what you're thinking. And again, if you leave a comment, I will leave a comment for you. And if you're buying in the dip, if you've held through Friday without selling, if you see $4,900 gold and $85 silver as an opportunity you've been waiting for, smash that like button right now. Subscribe to this channel. Turn on notifications, because Monday morning, when markets reopen, I will have something in the afternoon. I will definitely have a show in the afternoon, and hopefully have my research in by then, so that way I can bring you a show. Now, the bull market is not dead, in my opinion. It's just getting started. It is going to be violent. It's going to be volatile. And you need to be here for every move. Stay sharp. I'll see you in the comments, won't I? And I'll see you Monday when the breakdown aftermath happens. Let's stay positive. Have a great rest of your day. God bless.